Financial markets are among the most transformative institutions in modern history. Over decades, they have created opportunities for individuals to grow capital, fund innovation, and support economic evolution. Though risk and reward are inseparable, markets have rewarded patience, discipline, and deep understanding. Today's financial landscape extends far beyond traditional stocks and bonds. A new kind of market has emerged, a digital, decentralized system that functions 24/7, transcending national borders. It's not driven by physical factories or conventional corporate earnings, yet its influence continues to grow. This is a market where innovation meets uncertainty, where volatility reflects both opportunity and risk, and where millions of participants, from everyday individuals to institutional investors, seek clarity amid relentless change. Understanding the system requires calm observation, not hype. It demands respect for its structure and the realities of risk and reward. In today's interconnected economy, digital finance plays a central role. Traditional banking, payments, and investment platforms have paved the way for an entirely new form of financial asset: digital tokens secured by cryptography and distributed networks. This industry operates on technology called blockchain, a decentralized ledger maintained by computers around the world. It enables value transfer without the need for a single central authority. Companies, financial institutions, and individual users interact with this network daily, exchanging value, building applications, and seeking diversified exposure. Cities from New York to Singapore, London to Dubai have seen growing infrastructure supporting this digital market. Exchanges, custodial services, and institutional investment products now exist alongside traditional financial instruments. Despite its rapid evolution, this space remains misunderstood, fraught with volatility, and shaped by developments both inside and outside its ecosystem. At the core of this ecosystem is an asset that does not resemble a traditional company. It has no central CEO, no quarterly earnings report, and no physical headquarters. Instead, it operates through a global network of computers that validate transactions and secure the system. Its value is driven by supply and demand dynamics, trust in the network, and adoption by users and institutions alike. Revenue associated with this system comes from transaction fees, network participation, mining or validation rewards, and related financial services built around it. Market confidence in this asset fluctuates with regulatory developments, macroeconomic data, and broader trends in global finance. Recent news suggests growing legislative focus on clarifying regulatory frameworks, particularly in the United States, a development that has influenced market sentiment positively in the short term. Investors often interpret price swings as reflections of broader economic conditions, from inflation data to geopolitical uncertainty. This digital market does not operate in isolation. It remains sensitive to the same forces that move traditional stocks and commodities. The asset we have been describing is Bitcoin. Bitcoin is the first and most prominent digital asset of its kind. Launched in 2009, its design set the stage for an entirely new class of financial instruments. It exists on a decentralized network with a fixed maximum supply programmed into its protocol. These characteristics have led many to view Bitcoin as a digital store of value, often compared to scarce commodities like gold. Investors watch Bitcoin closely because its movements often set the tone for the broader digital market. When Bitcoin rallies or declines, other assets tend to follow. As of today, Bitcoin is trading near $95,194 USD, a meaningful figure that reflects real trading activity and market participation. Alongside Bitcoin, another major digital asset, Ethereum, is also significant. Ethereum is currently trading around $350 USD and serves as the backbone for decentralized applications and financial services built on blockchain networks. These price levels are not projections, but real, live indicators of current market conditions. Bitcoin's path has been marked by dramatic highs and lows. Its first decade was dominated by early adopters and technology enthusiasts. Over time, institutional interest increased, bringing deeper liquidity and wider acceptance, but also heightened scrutiny. Key milestones include its rise to mainstream awareness, its first major price surges, and the introduction of regulated financial products tied to its performance. All of these contributed to Bitcoin's integration into portfolios that go beyond speculative retail trading. However, challenges persist. Volatility remains high. Regulatory uncertainty continues in many regions. Short-term price swings can erode confidence. Critics point to energy consumption, perceived lack of intrinsic cash flow, and speculative dynamics as ongoing concerns. Despite these challenges, Bitcoin's core strengths remain. Its network security is robust, its scarcity is embedded in its design, its position as the leading digital asset is supported by global infrastructure and institutional engagement. Ethereum, similarly, has evolved from a protocol for smart contracts to a foundational platform for decentralized finance and digital applications. Its growth trajectory reflects expanding use cases rather than solely price appreciation. Both assets illustrate the balance of innovation and risk, where technological advancements intersect with financial realities. Looking forward, the digital asset market, anchored by Bitcoin and Ethereum, faces a landscape shaped by regulation, technological evolution, and institutional participation. Clearer regulatory frameworks, especially in major economies like the United States, could reduce uncertainty and attract more mainstream capital. Developments in blockchain technology may further expand applications beyond simple value transfer into areas like decentralized finance, tokenized assets, and digital identity systems. Yet, volatility is likely to remain part of the market's character. Price corrections, macroeconomic influences, and shifting investor sentiment will continue to shape short-term movements. Long-term adoption, however, depends on real utility, infrastructure maturation, and integration with traditional financial systems. Balanced optimism, rooted in realistic expectations rather than speculation, will be essential for anyone following this space. Bitcoin and its digital counterparts represent more than price charts. They reflect a shift in how value is stored, transferred, and understood in the digital age. This market does not offer guaranteed returns, nor does it operate without risk. It is shaped by technology, sentiment, regulation, and economic forces, just like traditional markets. For learners and observers alike, knowledge is the most valuable tool. Understanding market mechanics, historical performance, and current data allows for informed perspectives. Long-term thinking, research, and patience matter far more than hype or short-term noise. In the end, the story of Bitcoin and the broader digital asset market is not just about financial speculation. It is about how innovation continues to redefine financial systems and how individuals can approach this evolving landscape with clarity and composure. The journey of understanding begins with curiosity, and real, current data illuminates the path forward.